The American economy is lying to you right now, and almost nobody in the mainstream media wants to say it out loud. Unemployment sitting near 4.3%, inflation cooling to roughly 3.5%, Wall Street cheering, and yet underneath that calm surface, there is a war with Iran that has already closed the Strait of Hormuz once, there is a $1 trillion spending spree coming out of Washington, and there is a tariff policy that changes every single week depending on who Trump talked to last night. So here's the real question I want you to sit with for the next 25 minutes. If the chaos is this extreme, why hasn't the American economy already broken? I am going to give you the answer that most mainstream economists refuse to say publicly, and by the end of this video, you will understand exactly why this apparent calm is a countdown clock, not a victory lap. Before I go any further, I want you to do one simple thing. If you are new here, hit subscribe right now, because what I am about to break down is not the version of the story you are getting from CNBC or Bloomberg. This channel, Macroeconomic, exists specifically because the mainstream financial media has a habit of telling you the economy is fine right up until the moment it collapses. I am Alex James, and I track gold, silver, and the broader macro picture as an independent analyst, which means I have no bank sponsor telling me what I am allowed to say. Drop a comment below with the word buffer if you are watching this live, because that single word is going to matter a lot by the end of this script. So let's set the topic clearly. Today we are dissecting why the US economy is still standing despite tariff whiplash, an unresolved conflict with Iran, and government spending that is spiraling well past what Trump originally promised voters. This is not a partisan video. I am not here to defend or attack any politician. I am here to walk you through the actual mechanics of what is propping up the numbers, and more importantly, what happens when that support runs out. Because there is a difference between an economy that is healthy and an economy that is simply running on stored fuel while the tank slowly empties. Let's go back to where this administration started. Trump came into office promising to balance the federal budget. Remember the Department of Government Efficiency, the whole DOGE initiative fronted by Elon Musk, which was supposed to slash government waste and shrink the deficit dramatically. That was the pitch. Cut spending, tame inflation, and somehow also cut taxes at the same time. It sounded good in a campaign speech. Musk has since exited that role, DOGE has largely faded from the headlines, and the deficit has done the exact opposite of shrinking. Back in the second quarter of 2022, before Trump returned to office, the federal government actually posted a quarterly surplus of around $151 billion. Compare that to where we are now, with deficits widening again, and an additional $500 billion reportedly being floated for the defense budget alone. That is not fiscal discipline. That is the opposite of the promise. Now here is where I need you to unlearn something you were probably taught in a high school or university economics class. The textbook argument says a government deficit is bad because it drains resources away from the private sector, crowding out investment and slowing growth. That is the mainstream framing, and on paper it sounds logical. But when you actually trace where the money goes, this argument falls apart. And economists like Steve Keen, who was one of the very few to correctly warn about the 2008 financial crisis before it happened, have been making this exact point for years. Government spending does not pull money out of a fixed pool that belongs to the private sector. When the government spends more than it collects in taxes, it is injecting new money directly into private bank accounts. Think about your own relationship with the government. When you pay taxes, money leaves your account. When the government spends on you, whether through a contract, a job, a subsidy, or infrastructure, money enters your account. A deficit simply means more money flowed into the private economy than was pulled out of it. That is not a drain, that is fuel. This is exactly why unemployment is sitting near its long-run historical average of roughly 4.5% to 5%, even after ticking up from the 3.25% low of 2023. It is why inflation, despite peaking above 9% in June of 2022 during the COVID aftermath, has settled back down near 3 to 3.5%, which is actually close to America's long-run historical average inflation rate, not the artificial 2% target that central banks love to obsess over. The government has been pumping money into defense contracts, into AI infrastructure indirectly through favorable policy, and into a dozen other channels. And private sector investment in data centers and artificial intelligence build-outs has added a second stream of stimulus on top of that. Two engines running at once. That is the real reason the numbers look stable heading into the second half of 2026. But here is the brutal part, and I want to be completely honest with you instead of sugarcoating it the way most channels do to keep you comfortable. This stability is not evidence of good management. It is evidence of a government running the printing press through deficit spending while simultaneously creating the exact geopolitical and trade conditions that could wipe out the benefit overnight. You cannot close the Strait of Hormuz, threaten a $100,000 fee on skilled worker visas, flip tariffs on and off like a light switch, and expect zero consequences just because the deficit is temporarily masking the damage. The mask does not remove the wound. It just delays when you notice it is bleeding. Let's talk about the actual problem sitting underneath this fragile calm, because this is the part almost nobody wants to explain properly. The United States has been drawing down its strategic reserves, energy buffers, and supply chain slack ever since the conflict with Iran escalated and disrupted shipping through the Strait of Hormuz. Those reserves are not infinite. Every week that passes without a resolution is a week those buffers get thinner. The honest, unpopular truth is this: nobody knows the exact date those buffers run dry, but every serious analyst tracking energy flows and shipping data agrees that a 3 to 6 month window is the realistic range before the disruption fully hits American consumers through fuel prices, shipping costs, and downstream manufacturing inputs. This is where I have to be blunt with you instead of playing it safe. If you have been listening to certain mainstream voices calling for an all-clear on the U.S. economy right now, you are being sold a half-truth. Compare this to how a lot of the big bank strategists have been framing things lately, quietly walking back their most optimistic soft landing calls without actually admitting they were premature. I'm not going to do that here. The data right now, unemployment near 4.3%, inflation near 3.5%, does genuinely look stable on its face. Verified, current as of this analysis. But stable numbers built on unsustainable inputs are not the same thing as a healthy economy, and conflating the two is exactly how ordinary people get blindsided when the correction finally arrives. Let's break down the content piece by piece so you understand the full mechanism. First, the fiscal side. Deficit spending under this administration is trending larger, not smaller, despite campaign promises to the contrary, and a large chunk of new spending is being aimed at defense, which does stimulate employment in manufacturing and logistics sectors tied to military production. Second, the private investment side. AI infrastructure spending, particularly data center construction, is pulling in technicians, electricians, construction crews, and specialized labor at a scale that is genuinely propping up employment numbers independent of anything the government is doing. Third, the external shock side. Tariff policy uncertainty is creating a chilling effect on business investment decisions that has not yet fully shown up in the hard data, because businesses tend to delay rather than immediately cancel plans when policy is this unpredictable. Fourth, the energy side, which is the ticking clock. Reserve drawdowns from the Iran conflict have not yet translated into a full-blown price shock at the pump or in shipping costs, but that is a matter of time, not a matter of if. Now let's move into the analysis, because facts alone do not tell you where this is heading. You need to understand how these forces interact with each other. The core contradiction here is that the very thing propping up the American economy right now, aggressive deficit spending, is coming from the same administration that is simultaneously creating the external shocks most likely to overwhelm that support. It is like pouring fuel into a car with a slow leak in the tank. For a while, you can keep driving because you are adding fuel faster than it leaks out. But the moment your rate of refueling slows down, or the leak gets bigger, the car stops, and it stops fast. Right now, the refueling rate, meaning deficit spending plus AI infrastructure investment, is outpacing the leak, meaning tariff disruption plus energy buffer depletion plus geopolitical risk from the Iran conflict. That is the entire explanation for why unemployment and inflation both look reasonably tame today. But three things could flip this balance quickly. One, if the Iran conflict escalates further and completely shuts down a larger share of global oil shipping routes, energy prices spike fast, and inflation numbers you are seeing right now become obsolete within weeks. Two, if tariff policy stabilizes into something predictably harsh rather than chaotically inconsistent, businesses that have been delaying investment decisions will start making permanent cuts rather than temporary pauses. Three, if Congress or bond markets start pushing back hard on the scale of new deficit spending, particularly the reported $500 billion defense budget increase, the fiscal fuel that has been propping up employment could get throttled at exactly the wrong moment. I want to be brutally honest about something else too, because I think other analysts tend to dodge this to avoid sounding alarmist. This setup, deficit-driven stability masking underlying fragility, is not unique to America, and it is not new in economic history. What makes this instance dangerous is the compression of multiple risk factors into the same narrow window. You rarely see trade policy chaos, an active regional war affecting a critical shipping choke point, and an aggressive fiscal expansion all colliding in the same 6-month stretch. Usually these things are spread out enough that the economy can absorb one shock at a time. This time they are stacking. So here is my prediction, and I want to be clear, this is analysis, not certainty, so treat it accordingly and do your own research before making any financial decisions based on what I say here. Over the next 3 to 6 months, I expect the current calm to hold only as long as the energy reserve buffers from the Iran conflict last. Once those buffers are meaningfully depleted, expect a visible uptick in inflation readings driven by fuel and shipping costs, which will likely force the Federal Reserve into an uncomfortable position of choosing between fighting inflation with higher rates or protecting a labor market that is already showing early cracks. I expect unemployment to drift further from its 2023 lows toward the higher end of its historical range, not because the deficit spending stops, but because the private sector side of the stimulus, particularly the AI infrastructure build-out, cannot indefinitely offset the drag from an unresolved external conflict and unstable trade policy. For anyone tracking gold and silver specifically, which is the core focus of this channel, this combination of persistent deficit spending, geopolitical instability tied to Iran, and a Federal Reserve caught between inflation and employment mandates is historically the exact environment where precious metals tend to see sustained demand as a hedge. That is not investment advice. That is simply the historical pattern this setup tends to follow, and you should verify current spot prices yourself before acting on anything, since rates and levels move by the day, and any specific figure I quote here can be outdated within hours. Let me leave you with the honest bottom line instead of a comfortable one. The US economy is not thriving right now. It is being subsidized into looking stable by deficit spending, while the administration simultaneously lights fires it cannot fully control. That is not a stable foundation, it is a countdown. The people telling you everything is fine are either not looking closely enough or they have a reason not to tell you the full picture. If this breakdown helped you see the numbers differently than the headlines are presenting them, hit subscribe to Macro Bullion so you do not miss the next analysis. Drop a comment with your own take on how long you think those energy buffers actually last, and share this with someone who still thinks the deficit conversation is boring, because it is about to become the most important number in the entire economy. As always, this is independent analysis, not financial advice, so do your own research, verify the latest rates and data yourself before making any decisions, and I will see you in the next one.